You've probably seen the headlines. Warren Buffett says mortgage rates aren't coming down enough anytime soon to ease the affordability. And here's the kicker. Even if rates drop to zero, most people still couldn't afford the homes they want. If you're planning to buy a home, this is a very upsetting news. Let's break it down. But first of all, I want to know what you think. When would interest rates and home prices drop? Write in the comments. Here's what came out recently from Warren Buffett's Berkshire Hathaway mortgage arm, and it's backed up by Zillow and other major housing analysts. For the rest of this year and through 2025, mortgage rates are likely to hover in the 6.5%, they say. There may be a slight dip in 2026, but nothing game-changing. And even if rates dropped a full 2 percentage points, housing will still be historically unaffordable in most major metro areas. Buffett's team isn't saying this to scare people. They're saying it because they've run the numbers, it's an educated guess. This is the guy that told everyone in 2011, 2012 to buy, because they said low prices, home prices and low interest rates is not going to happen again in your lifetime. Of course, he didn't know a pandemic was coming, and after it was done, it ruined affordability for everyone, but also lowered the mortgage rates. People who bought in 2011 refinanced their loans even lower to 3% or less. You know that. Do you think the people who bought then will be able to sell now and buy another house? And with 6.5% interest rate, do they really have to sell to do that? Inventory is still low in some markets like Northeast and Midwest. Prices aren't dropping in those regions, and demand isn't going away, especially in Boston and suburbs where I am. Now, it's interesting to see when the rates were since 2020. It started at 3.72% in 2020, went even lower, then sharply higher in mid-2023, even higher in 2024. Now we are around 6.5%. Now, as a viewer of my channel, scan this QR code to schedule a free 45-minute call with me. If you're moving to Boston and the suburbs, I can help you tremendously. Realtor.com states that most experts agree meaningful relief may not arrive until 2026 or later, as mortgage interest rates are unlikely to decline. The decline in rates increases prospective homebuyers' purchasing power, and our research shows that buyers can save thousands by getting quotes from a few different lenders, says Sam Hader, chief economist at Freddie Mac. Here's the reality. The Fed doesn't want to cut rates because the inflation might go even higher. I get that. But when I look at this chart, I see that it is not a linear relationship between home prices and interest rates. Interest rates are lower now than they were in September 23, but prices keep going up. Even though home prices are higher overall, sellers are not flooding the market. Why? Because many of them are sitting on mortgage rates 2 to 4%. Selling means buying again in today's rate. So they're saying, you know what? I'll stay in my old house. This all means fewer listings, tighter supply, and yes, home prices staying firm in the Midwest and Northeast especially, and even growing in price by 2 to 4%. In my previous short, I was saying about the rate of delistings, meaning taking the homes off the market after it stayed on the market for a month or something, and that rate is 35%. The inventory is just disappearing from the market, and the number is actually higher when you compare to last year at 47%. Warren Buffett's team seems to be much more pessimistic, compared to others. Hannah Jones, who is a senior economist analyst at Realtor.com, says many analysts expect the Fed to begin rate cuts in late 2025 with the additional reduction in 2026. The forecast says Fannie Mae is the most optimistic among many forecasters, projecting a rate of 6.1% by end of 2025 and even 5.8% by 2026. So if the interest rates decline, affordability gets better. But inflation and broader market conditions will determine how much of these Fed cuts translate into lower borrowing costs and what happens with home prices. Oh, by the way, countries like Sweden and Canada had their home price correction already. Home prices haven't fallen because of the existence of 30-year fixed mortgage rates. In markets like Canada and Sweden, where adjustable rate mortgage and shorter terms are the norm, there's been breakdowns in their housing prices related to higher rates in their own market. Just like most housing data, national averages of course don't tell the whole story. Let's talk about Boston. We're not seeing mass price drops here. Boston has a unique mix of stable job markets, think finance, biotech, tech, and education, high desirability for relocations because of the jobs, and limited buildable land. And that creates kind of price resilience. So if you're moving here waiting for the big drop in prices, it will cost you more to wait. Why? Because while you wait, prices creep up and competition builds. It's not going to be cheaper next year unless we hit a major recession. Even if mortgage rates were 0%, median income buyers in many areas still couldn't afford the median priced home. That's how big the gap is between home prices and wages. The better question is, what can you buy now that will work for your needs and still be a smart investment long term? My name is Nouné. I'm a real estate agent in Massachusetts. Reach out to me and schedule a 45-minute free virtual call and watch my next videos.